Hello and welcome to the depreciation amortization video. In today's video lesson, we'll be looking at the question of how do depreciation and amortization affect cash flows? And to answer that question, we'll be looking at what are depreciation and amortization, what are depreciation and amortization's effect on taxes, and then we'll do a separate video on how we actually calculate depreciation and amortization. And so we'll first begin at looking at the definition for depreciation and amortization. And it's simply stated as the accounting allocation of an expense towards the use of assets. And so that might not make a whole lot of sense, but we'll put it into context really quickly. So over time, machines start to wear down. So when we purchase an asset, usually PP&E, we'll be looking at purchasing with cash. We buy that piece of equipment and we use it. And over time, that piece of equipment is going to wear down. And so we can actually expense that use of the asset over a set time period. So another thing to keep in mind that's pretty important will be depreciation is slightly different than amortization. When we're looking at these expenses, depreciation is linked with physical assets such as buildings and equipment. As I just explained, those buildings and equipment will start to wear down over time. But when we look at amortization, that's actually linked with intangible assets. Keep in mind something around the lines of patents. So when we do have a patent for some sort of technology that we have within our business, over time there'll be new technology, there'll be new things that come out, some cutting edge technology, potentially could make our patent not worth as much. So over a set time period, we can actually decrease the value in our books for those intangible assets. So now we'll look at depreciation amortization's effects on taxes. So here we'll see the net income statement for Manufacturing Inc. So we see the depreciation where it's placed, and it's actually placed above our taxable income. Right here we see our tax expense being highlighted. And what that means is that our depreciation is above our taxable income, meaning that that expense is coming out before we actually adjust for taxes. So what this really gets at the point at depreciation amortization act as a tax shield. So for every dollar of depreciation amortization expense that we take out, there's actually one less dollar that's subject to taxes for our company. So why might this be important? So when we're looking at purchasing an asset, we're doing that with cash. So we purchase that equipment, we pay with cash, and then we expense that asset, and we're really just decreasing the book value of that asset. But when we're making that expense, there's actually no change in cash when we're looking at it from an accounting perspective. It's just an expense that we're putting on the books. So what this really gets at the point at is that depreciation amortization, there's no exchange of cash, and therefore that means that this expense has no direct impact on our cash flows. So when we begin to look at a variable known as our free cash flow, we see that depreciation and amortization are known as non-cash expenses. So now in this video section, we'll take a quick look at how we actually calculate depreciation and amortization. And so for this, we'll be looking at the most common form of depreciation, which is straight line depreciation. And a company calculates this type of straight line depreciation by expensing the same amount for depreciation or amortization each year that they make this expense. And they'll do that up to a salvage value or to the useful life. So we'll look at the equation real quickly. We have our depreciation expense for straight line is the cost of the asset, so the amount that we pay in cash, minus the salvage value. So when we're looking at a salvage value, we're really thinking of if we have a piece of equipment and we think that we're going to use it over 10 years, that would be our useful life, but our salvage value would be in the event that we decide to sell that asset. So if we were to sell, let's say we purchase it for $10,000, and then we think that at the end of 10 years, it's going to have a salvage value of $2,000, we would actually then take that amount off of the cost of the asset because we are going to sell it. And in that case, that is another exchange of cash. So we take that difference over the useful life to calculate the amount that we would expense in depreciation or amortization for each year. So now let's take a quick look at an example we'll run through just what the calculation looks like and how we get to that straight line depreciation. So we have, for example, let's say the Computer Services Inc. decides to purchase equipment for $10,000. And an important note is that Computer Services Inc. believes that they will only need this piece of equipment for 4 years. Additionally, they believe that at the end of the 4-year period, that they'll be able to resell their equipment for $2,000. So when we have that equation, we're looking, one, for the cost of the asset, the amount that we're going to pay up front for that piece of equipment, and we know that that's $10,000. We also know that they believe once they're done using this machine that they're going to be able to sell it for $2,000, and that they believe that they're only going to need this equipment, or the useful life for this piece of equipment will be 4 years. So we plug that into our depreciation expense equation. We get $10,000, our cost of our asset, minus our salvage value of $2,000 over the 4-year useful life, and we get a straight line depreciation amount of $2,000. So when you look at that depreciation expense on an income statement, each year for this specific piece of equipment, they would be adding $2,000 to that depreciation expense.
My name is Rick Haskell, and I'd like to thank you for watching this video as part of the Bill and Vieve Gore School of Business's Business Certificate Series. I'm a finance professor in the business school, where I'm also the director for the college's Center for Financial Wellness. The Business Certificate Series is offered through the Center as part of our outreach through the Gore School of Business. You can follow us on social media through Westminster's Instagram, YouTube, LinkedIn, or Facebook pages. You can use the QR codes provided or simply go to these websites. Thank you.